This is Pete Moore, managing partner and founder of Integrity Square, the leading financial advisory firm in what we have called the Halo sector. We do Halo Academy every Wednesday, a 2 minute drill. On Thursdays, we're going to have Halo Talks fast breaks. These fast breaks are going to be 3 to 5 minutes with entrepreneurs and executives who are running awesome businesses that you need to know about. What we're going to ask them on these fast breaks in the future is what's your offensive playbook? How do you go to market? And how do you win? So today, what I'm going to do is I'm going to go through an offensive playbook so you understand what that is and also think about how it works in your business. So first of all, here's all the deals that we've done over the last 10 years. This is just a smattering of logos so you know what we're talking about. Look at the fitness industry back when I started back in 1999 to 2024. You used to be able to say, hey, I'm in the health club industry. No longer. You have to say what category you play in. And each category within the health club industry has its own offensive playbook. If I'm a Planet Fitness at the bottom, I am a low cost, high volume player. If on the top right, an Equinox or a Lifetime, I am doing return on trophy assets. I want to get dollars as much as I can out of a member, not load the place up with as many members as I can. And if I'm a boutique such as Soul Cycle, which I love, Barry's Boot Camp or Orange Theory, I am a return on a cult. If I take a look at the playbook and the offensive playbook that I use for Planet Fitness, it's all about marketing. Nobody else spends $12,617 per month plus a 2% ad fund, which now equates to a $100 million ad fund nationwide. If I'm a Planet Fitness and I'm a football team, I am actually at a 32-point advantage against any other health club. Just like back in the day under Nick Saban, Alabama Crimson Tide plus 32 or minus 32 if you're playing against them. Okay, why is that? Well, I use ACH and I don't use credit cards. I got an annual maintenance fee that I'm billing on 10,000 members instead of 7,000. I got relatively low labor costs because there are only 3 people on my field. I've got no sales commissions. I have no personal training, which is a plus and a minus. I have no Group X, so there's really nobody else to pay or run reports on. I don't have any ancillary revenue, and I also don't have any ancillary cost. The color of my place is purple. Why is that? Because I'm not having you stay long. This isn't a chandelier, and this isn't a day spa. I got a lunk belt to remove serious lifters. You know why? Because they take up too much space. And I'm trying to run an airline effectively with as little obstacles to my success as possible. And I've got area developer agreements for investors to basically own cities and states. So, in summary, a left hand side, my playbook is return on marketing and parking if I'm a Planet. If I'm a Crunch, a Gold's Gym, or a middle market player such as a One Life Fitness or an EOS, I'm playing return on relationships and results. If on the high end, I'm a return on trophy assets. And if I'm a boutique, I want to make money on getting revenue from my cult. As you take a look at some of the KPIs, I might look at the square feet per member. If I've got a club like Lifetime Fitness, I might be at 10 or 12 square feet per member. If I'm running a Planet, I want to be at 2 square feet per member. If I'm looking at my total members per location, that might be important, but it might be not be as important if I'm running a trophy asset. If I'm looking at my revenue per member, what do I care about? I care about if you're a highly disposable income crew, I want to get as much wallet share as I can. If I'm a Planet Fitness, I want to get 20 bucks a month and then I want to get a $39 or $49 maintenance fee. If I want to look at my clubs based on total EBITDA, all right, this is how much cash is flowing through after all my revenue and expenses are accounted for. And what I want to make sure I do is try and get as much intelligence out of my system as I can to keep you as a member. If I look at how the analogy is between what the rates are for lap band success rate and gastro sleeve success rate on getting people to lose their bellies, okay? That's basically what the average is in a health club. I'm losing 50 to 60% of my members a year. So, how do I optimize my playbook in order to enhance the value of my members and start to play man to man versus playing zone? All this information I can get from my members that's going to increase my retention, which is going to increase my EBITDA, is all about getting that information and using groups like Promotion Vault to incentivize my members to get in there. So make sure that my operating playbook is a winning playbook. If I take a look at private health club valuations, you could go from 5 times EBITDA up to 13 times EBITDA. And that is because the playbook and the prototype that is being deployed is bulletproof. When I open up a new location that's a Planet, I know that I'm going to generate $2.2 million of revenue and $700,000 of EBITDA. And if I have a entity that has the right to open up more planets, I'm going to get way more than 5 times EBITDA. Whereas if I'm one club or two clubs or five clubs and I don't have any growth and I might not be in a brand that's ramping, it might be 3 to 5 times EBITDA. So the operating playbook is your success formula playbook that tells us how we're going to win, how we approaching the game, and what players do I have on the field. So if you want to win, you want to learn more at Halo Academy, and you want to get information out of the fast breaks to ensure your success and to be best in class, log in, stay with us every week. We're going to make you smarter, and making you smarter gives you a higher probability of getting capital when you want it. Over and out. Go Halo. PD Mo, Captain PD Mo. See you next week.